The simple math of a $1 million ARR recurring revenue business, this is the fundamental principle of recurring revenue businesses. The simple rule here of a $1 million ARR software business that grows at 30% a year, right? Not crazy, reasonable pace. That's pretty good. But if you do that for 9 years, you'll have a $10 million business, okay? And if you do that for another 9 years, you will have a $100 million business. That's probably worth $1 billion by that time. Okay, so that sounds simple, and not everybody gets there, of course. We know that in the long run, the 10 years, the 20 years, compounding makes the difference. It's a healthier approach. We actually like this approach, generally speaking. We understand the math, and yes, we're doing it. Most people don't really sign up for this kind of thing. Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. Today, your guest is me. I don't have a third-party guest. It's a busy time in the fall. Everybody I had scheduled for the last week to interview on the podcast had to push, and we have busy schedules. So I'd like to share some insights with you. I'm out here talking to thousands of founders in the last few years, working with 40-plus founders in my Practical Founders CEO peer groups every single month, talking to founders on the podcast, talking to experts. I've got a few insights to share that aren't just another founder story. So today, I'd like to share some of those thoughts, the 3 critical but not obvious traits of serious practical founders who are winning the game. I'm out here talking to so many people, interviewing founders on the podcast, interviewing other founders who don't make it to the podcast, who've succeeded, and working with so many founders here. There are some common traits that I'm seeing about the practical founders who are winning the game and succeeding on their own terms. I'm a little bit like, I say, Greg GPT. I'm pre-training my model with everything I'm hearing from every founder I talk to on the podcast and otherwise. So I'm learning what's working, what's not working, all the variations, all the differences and diversity that's there. What are the fundamentals that are there? That's my curiosity. I do the podcast as much for me and my learning and to hear another amazing story from a founder as for you to hear the stories as another example. Another way to do it is pretty much the goal of the podcast. Here's another way to do it. And there's no 2 founders who've done it the same. But there's some patterns here that are really important, and they're not so obvious. So I'd like to share those with you today. These are the important traits of serious practical founders who win the game. And I'm not selling you on these traits. I'm not saying you're bad if you don't do these and you're good if you do these. That's a little too much here. There's many ways to win the game in entrepreneurship, in life. Being a practical founder is just one way to do it. I'm not trying to persuade you that this is the answer. I'm really trying to attract you if these are the things that appeal to you, your way of thinking, your DNA, your vibe, your style, your approach, which is different than everybody else. I say that most entrepreneurs are abnormal. Doesn't make us better or worse. It just makes us atypical and not like anybody else on our block. And practical founders do think differently. It isn't common knowledge. I say practical founders means reasonably crazy. So we have a reasonable and practical, frugal side. We also have a crazy betting, growth, investing, high impact side. And we play both of those together. They go together. It's a little schizophrenic, 2 minds there. So I want to talk about the 3 things, the 3 themes I'm seeing out there, and I've been doing this a long time. But before I start with that, I'd just like to say thanks to all of the loyal listeners. Every time I go out to a SaaS conference and meet founders that I don't know, there's always a few people in the crowd that say, I've been listening to your podcast. They can quote one of the episodes and say, I really enjoyed that one. And the guy said this, and I was able to take that away. I really appreciate that. And that's why I do the podcast. Not so you're taking every podcast as a template of success, but you're comparing what you're doing to what you're hearing and finding the similarities and some takeaways that you can integrate and you find useful and practical to create leverage in your own business, your own journey. So that's one of the traits of practical founders. We're independent. We don't like when somebody says, "Here's how you do it." I don't like that. But I like to hear stories and find the takeaways there. So every time I go out, I meet somebody who's listening to the podcast and really enjoyed the story. So thank you if you're a guest. And, Craig and Justin and others who listen to most episodes and send me notes. I really appreciate all of that. That's why I'm doing this, to share it with you. If you're an avid listener and I haven't met you yet, I would really appreciate it if you just send me a note at greg@practicalfounders.com and tell me what you find useful out of the podcast. Something that, you found a takeaway or the reason you keep listening. So I hear that from you. It's really hard in the digital universe to have those kind of conversations and see what's working out there. Really appreciate that. And if you want to share something you'd like to see improved or a guest you'd like to see or another format, there's another format today to try. I've been doing this over 3 years, interviewed over 165 guests, over 140 founders that have created more than $10 billion in net founder equity value. So maybe they had some angel investors, so we're not counting that. Maybe they've sold all or part of their company. They've realized some of that, or they haven't realized it yet. So that's kind of my conservative estimation of what those companies are worth as a whole. 130 companies is scratching the surface of the tip of the iceberg of all of these practical founders who we don't hear about, with their VC funding. And, we just hear about the few big exits of those. We don't get to hear their stories. This is the hidden majority of software companies out there that we don't hear about. So the goal of the podcast is, of course, to share the stories you don't hear and all the different ways you can do it and the insights behind all of that and the great founder stories underneath all of that. So, yeah, if you're a listener, you can always send me a note at greg@practicalfounders. I'd love to meet you. And, I have a lot of conversations with founders that I'm learning from as well. Each of your journeys I'm learning from. This is a practical game. It's not religious. There's not one right way to do it. There's some laws of nature that work as a whole and create leverage and amazing results and value for entrepreneurs. And there's things that change every week, and the world keeps changing. It's part of the puzzle I enjoy is what hasn't changed in 30 years in this business and what is changing this week in this region, in this market with AI and everything else. It's a fun puzzle for me, and look forward to hearing from you there. The question I get when I meet founders who listen to the podcast, maybe it's not so clear, but they say, "Greg, what do you actually do? I know you're passionate about this. I know you love the practical founder zone of these kind of crazy and serious founders who did these amazing things against all the odds and, took the time to build something valuable." So I'll answer that question here just briefly. My main thing is, it's almost my only thing. I guess I do the podcast and a few other things here, is the Practical Founders CEO peer groups. So these are paid CEO peer groups with serious practical founders, almost all between 1 and 10 million. I just started a group with 10 to 20 million ARR software founders, bootstrap founders who are going long and built something amazing and valuable. So we're starting to see maybe 20% have over more than 10 million. But the majority right now in my first 4 peer groups of 8 to 10 founders have between, say, 2, 7, 1 and 10, maybe they're kind of the median maybe is 5 million, something like that. But it's a span. A few that are serious and over the product market fit hump, just under 1 million, and others heading over 20 million. In this game that compounds, right? If you do it long enough, your $3 million business turns into a $15 million business. And I've seen that in my groups. That's kind of what we're creating, is be able to stay in the game, to grow faster, to do all the hard things with a peer group of people. There's many ways to get help. You can Google it, you can chat GPT it, you can call your founder friend, you could go to the ecosystem, you can watch YouTube videos, go to a conference, read books. We're doing all of those things. These serious, practical SaaS founders, all B2B SaaS founders in North America, Canada, UK, and other parts of the world on top of that, but that's where the majority are. They want to be around other founders who are about at their same stage, trying to get through these hard things. And yeah, there's different ways to do it, but they're all B2B SaaS founders who didn't take any serious outside funding. They're in control and independent, and they're getting through the hard things. So the founders in my peer groups, now just up to 44, 45, amazing founders. I have fun working with them. They want to share their challenges and hear the challenges of other founders and help and get help every month on the podcast. So it's lonely to be a practical founder out there, a CEO, your neighbors, your spouse, your employees, your senior leadership team. There's a subset of things you can't talk about with them, and you got all the weight of this. And if you're not near a big ecosystem, some of our founders are, not in a big city around other founders too. Being around other people helps you in the game, helps you stay sane, helps you do the hard things, help you get the insights and get the insights that are useful for you with your situation. We call that context, not content. There's templates and plenty of content out there for SaaS founders. We're not reinventing any of that. But for you today in your business and your market with your personality for what you want to create, what should I do with this? That's a little different. So we have a lot of founders who have been part of EO and Vistage and YPO and other CEO peer groups in their local areas, but those aren't focused on B2B SaaS, and they're not deep B2B SaaS. So you may be the only one in your group in the SaaS game or the software game. And we know that the leverage in this is not in the funding, outside funding, big outside funding. It's in a couple levels down in deep SaaS. It's not just CAC to LTV. It's your deep insights now that you're down a few levels, figuring for you and your market what's going on and where can you add leverage there. And we're all going through the crazy journey together, whether it was coming out of COVID and tariffs and AI and other shifts in the world. We're on the front lines of this. And, everything that shows up at ChatGPT or a book is a little bit behind. So we're processing this AI revolution month by month together to see what's useful, what's practical, and the rest, the stuff you can't Google yet, and so forth. So it's a lot of fun. I love doing it. I'm a crazy helper, extrovert. I love the puzzle of the game. I literally curate the groups, moderate the groups every month, and support the founders in the group. So it's what I do. I'm not trying to create a super scale kind of thing there. So I love doing it, and I'm going to do it a long time. If you're curious about the Practical Founders peer groups, I think if you listen to this episode today and, the top 3 traits you identify with and you're a B2B SaaS founder, let's have a conversation. Check out the peer groups. Not everybody's wants to be in a peer group. It's a special kind of way to process your key issues and improve your business and keep going. Let's have a conversation and, check it out. I'm starting another scale Practical Founders group this fall to start at the beginning of the year. So I'm forming a new group and there's some space available right now. So if you want to have a conversation about that, check out practicalfounders.com, CEO peer groups, and let's have a conversation. So I'm going to talk about the 3 traits of practical founders. And, like I said, there's many ways to do it. Practical Founders is just one of the way. It's a certain style. If you're listening to this podcast and you've heard me before, you're probably a lot of this style. So it reminds me of the old Jeff Foxworthy, funny comedian from the southern U.S. with a big accent who has the shtick, the routine of, you might be a redneck if, right? And he's not trying to offend his let's say his redneck crowd. He's tried to identify with them and get them cheering and, all the funny stuff to poke fun at themselves. So, we'll do the same for practical founders. You might be a practical founder if. So we'll talk about that. All right, here's the first one. You might be a practical founder If you're driving a 5-year-old car and you live in a modest house and you have some savings and you're not spending it all on fancy stuff, yet you have built a software business and you're already getting inbound emails from everybody, and sometimes offers to sell your company for 10 or 20 million, and you're turning it down. Seems like a contradiction out there, but it's very common for practical founders. They have built something that's up and running and starting to get more valuable and keep on growing, but they're frugal and don't have a fancy lifestyle. They're not the cool kids. And they're kind of, let's say, crazy frugal, and they're saving on one side and they're investing on the other. Those are very uncommon together. You might be a practical founder if you've got an up and running software company. Maybe it's 500,000, 2 million. I mean, you still haven't really paid yourself a serious salary yet. And it's not because you can't or whatever, but you don't have to. Maybe you've got some savings and haven't sold your other business that kept you going. You're surviving just fine, and you're finding a better way to invest. I'd rather invest that next $100,000 in a great employee, a great coder, great salesperson that's going to help us get to the next level. You're building this asset. So it's another funny contradiction of practical founders. It isn't very common out there. You go in your neighborhood, you're probably one of the more frugal people on your block, and people have no idea, just like The Millionaire Next Door, popular book in the 90s, the kind of asset you're building or want to build, and then you're planning to build. It's not very common out there, but it's kind of one of the practical founders' traits. If you look in hindsight of the ones who've created the success stories that say, how did you get there? They didn't get there because they had tons of money and they just spent money on it, raised a lot of money, like that's the crazy bet out there. They found a way to be successful and have some savings, some capacity, some time, some energy left over to, build something else and invest on that. It's actually it's not normal behavior for entrepreneurs and the lore of entrepreneurs and the Silicon Valley startup thing. Bet it all. We see this in the movies. Those moments you had to bet the company over and over again. It's not how practical founders work. They have some safety on one side, their savings, their conservative investment on one side, and their company is kind of the crazy bet. And not everything in their company is a crazy bet. So it actually has to do with the betting strategy and the risk strategy for practical founders. It's a certain style. Not everybody does it. And if you go to your software ecosystem and the funders, brought to you by the funding industrial complex, they're going to say, oh, I'd bet it all and I'd take funding. VC funding and institutional funding isn't wrong or bad. It's just a bet it all proposition. Why would you do that? Practical founders look at that and say, that would be silly to say I could take that money. But then if it doesn't work and the time frame and with the lack of control that I have, then I kind of lose the game. That seems kind of silly. How about I'm safe over here and I can make smaller bets to turn into bigger bets, right? That's the risk, let's say, profile of practical founders. For a lot of things, they're not risky at all. There's a safe foundation for them that they know they can live off of and go back to and so forth. And then they make smaller bets they want to turn into bigger bets. As Jim Collins used to say, bullets before cannonballs. Nail it before you scale it, right? In the Silicon Valley right now in AI, it's not like do small tests and we'll see, and then we'll roll it out and do a little bit bigger tests and so forth. It's kind of like, present your big strategy, bet it all, and if it doesn't work, so be it. It won't work out. Practical founders don't think like that. And this isn't normal behavior. All of your employee neighbors and maybe some of the people that work with you, they're employees. They're not betting big like you do. So it's this, reasonably crazy. It's two minds, schizophrenic, that people don't do together, right? There's an extreme frugality on one side and, eventually some bold bets when you have the confidence. So it's not that you're risk averse or very, risk savvy. It's a totally managed risk game out there. It's actually kind of uncommon. for small companies. But at big companies, this is how they do it. They have their core business, and then they have their innovation bets, right? Then they'll test it small and then roll it out and so forth. They can't make big, crazy bets unless you're Elon Musk or something like that. Big companies operate like this, which seems totally crazy to the bet it all VC funded founders out there. I remember in the dot-com era of 2000, 2001, way back when, I had co-founded a company with a team of people. We had grown it up. It was in the practical VC funded days, I would say, of the 90s. And we had a core business there. We acquired the business that I'd helped grow and create before, called with the Software Act, about a $20 million business. And I came back to run Act. So we were a $100 million company and public by that time. So I went back and forth between the dot-com division saying, bet it all, you can't spend enough money, it's all going to work, all these crazy startup mentality bets on one side. And I went back to the business we had sold 5 years earlier that was kind of in a sleep mode and everything was totally conservative. So on one side, I was the crazy bettor. I wanted to move the old business, the Act business, faster. And I had some confidence about that. And then I went back to the dot-com and I looked like the fuddy-duddy. So practical founders are kind of in the middle, thinking about how do we have something steady on one side and make small bets and bigger bets. And it's a really interesting puzzle. We don't want to bet the company. We don't want to bet our life. When you raise $5, $10, $20 million of VC institutional funding, you're betting the company every single time. If we don't get to the next level, we're out. And founders bet the company and their lives. I'm all in, up to my, 110%. If it doesn't work out, most founders don't know they're signing up for, that all or nothing bet. The strongest opioid drug you could prescribe for somebody with a headache. Practical founders are somewhere in the middle. We look like normal practical people on one side, in some ways more extremely frugal and serious than most people, and on the other side we have some kind of crazy. A new practical founder that joined one of my groups, looks like a very steady, serious founder, very practical. You could almost say conservative sounding in there. And then now you say, well, what do you do in your spare time? Well, I'm a pilot and I do aerial, maneuvers with planes. So, there's a contradiction, if you will, of practical founders. On one side, they're humble and frugal, profitable in some part of their business, and very systematic. And another part, they're making bigger bets that could turn into bolder bets. Right? It's pretty amazing to see when somebody's created the confidence and they say, I'm not going to take my salary I'm going to double down on something. This is all about the leverage, right? It's finding leverage, not just to invest in something that gets back the same investment, but invest something that gives me back 10 times, something that helps us grow faster, that turns into a higher multiple. Not everything does it, and it takes a while to figure those out. So it takes some patience as well, and timing and so forth. So it's like fast, fast, slow, 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 fast, 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 slow, slow. A little different than most people. Like this kind. I'm reminded of Warren Buffett and Charlie Munger, the Berkshire Hathaway compounding investors, where they have a lot of cash right now. But if something happens, they'll move it with conviction to make the right bets. And that seemed to work for them. We generally think like that. We don't bet the company. We don't bet our life. We don't bet on VC funding, which practical founders know is an all or nothing bet. And we stay away from that. We find leverage in the things we do, and we do it over and over, which leads us to the next trait of practical founders that is not so obvious, but really important. You might be a practical founder if you aren't looking just for the quick fix, the magic trick, the super thing to grow fast and accelerate that everybody seems to be talking about on social media and content. You're going to do the right things that every day that build value and improve the compounding game, which is so important to the SaaS model, to exiting in SaaS, if you want to create a valuable company, the ones that buy you want to know that it's going to keep compounding like a flywheel, right? With low churn and reasonable growth and lots of momentum. Those things don't happen overnight. And the second trait of practical founders here is we love the compounding game as much as possible in our crazy entrepreneurial adventures. We're building something that we want to keep growing 2 and 3 years from now. So we're going to do the atypical things today to improve the product, to make the little changes in our organization and our pricing, to build a compounding machine that's very different. So, compounding is so important. The things we eat today, the exercise we do, the habits we have turn into the health we have in 10 years. And if you look back at, your health issues now, almost all of them are a result of the habits, the daily routines, the improvements you made, the things you did in the last 10 years, for better or for worse. So, compounding is easy to say. The math sounds reasonable to most people. If you just invested so much every month, invested in a conservative stock market fund, then you'll be rich after a period of time. Well, that's so obvious. How come almost nobody's doing it? If it's so easy to be healthy and have those habits, how come few people are doing it? It's because compounding is not easy. It's not typical. It's harder than it looks. And it's also kind of a general approach that the world isn't really organized around. Nobody's selling the compounding game out there. VC funding is certainly not selling it. Fast food is certainly not selling it. Most of the YouTube and social media clickbait, it's all about quick fix. And, practical founders don't really appreciate that. We know we're building a wonderful SaaS flywheel machine with customer value, with employee satisfaction and leverage, with productivity that keeps compounding. The simple math of a $1 million ARR recurring revenue business. This is the fundamental principle of recurring revenue businesses. The simple rule here of a $1 million ARR software business that grows at 30% a year, right? Not crazy. Reasonable pace. That's pretty good. Maybe it shows up in the rule of 40. Maybe you have 10% profits in there on top of your 30% growth. But a 30% growth of a 1 million ARR, which if you go to Silicon Valley, they're going to say, that's pretty crappy. I don't know if that works. But if you do that for 9 years, you'll have a $10 million business. Okay. So, and if you do that for another 9 years, you will have a $100 million business. That's probably worth $1 billion by that time. Okay. So that sounds simple and not everybody gets there, of course, and so forth. But practical founders think in this way. It's not the simple math of compounding, which Warren Buffett and Albert Einstein says, one of the wonders of the world is compound interest, that grows and grows. But we know that in the long run, the 10 years, the 20 years, compounding makes the difference. It's a healthier approach. We actually like this approach, generally speaking. We understand the math, and yes, we're doing it. Most people don't really sign up for this kind of thing. How about if you did this every day for the next 10 years? Most people won't sign up for that. It kind of makes a moat. If you're improving every month, you as a CEO, your product, your marketing, your value that you're creating for customers, your differentiation, and improving and improving and improving, that builds and builds and builds over time. Any of you that have done the long run in companies know this. The bad habits also compound and, get intractable and, slow you down. Practical founders think like there's a style. That's kind of the approach, which is, yeah, I would sign up for 30, 50, 20% growth, some steady kind of improvement. It looks, let's say, conservative or fuddy-duddy to the crazy VC-funded growth startup community. That's not very exciting. Doesn't make for great clickbait. That's why one of the reasons that practical founder stories don't get told very often is because it's kind of boring to do that, as Warren Buffett and Charlie Munger will say. But it makes for amazing results, right? A $10 million software company that you just steadily grew. And, maybe after the 9 years of compounding at 1 million, which means it probably took you a few years to get to 1 million if you ever got there, that's probably worth 70 million. And if you can grow at that pace without funding, by the way, that's not appealing to a VC of any type. How about we take 10 years and sell it for 70 million or create a $70 million value business? That's life-changing for any founders. And VC funded or not, these software businesses do take 10 years to get valuable, whether it's VC funded or not. Most VC funds are saying, geez, we thought the fund term would be 7 years, but it's really 10 to 15 years to get the payoff from those VC funded investments. And it looks like that for practical founders as well. 90% of people in the world won't do those hard things, the right things every day without seeing immediate results. That's how compounding works. You don't see the results. It doesn't show up very quickly. But if you keep doing it, the longer you go, the higher it gets, right? Nothing, a little bit, and then all at once, right? That's the kind of compounding exponential game. Yes, there's other things going on. There's opportunities to grow faster. There's challenges that happen in the world. COVID created a lot of challenges, interrupted the compounding growth game of so many SaaS companies. It is the reason that SaaS companies are worth 5, 7, 10 multiples of revenue and more of revenue, and not multiples of profit, is their compounding steady growth machines with high margins that somebody else could continue and grow. Like you want to, that's the reason somebody would pay a high price, is we think it'll continue to grow. It is one of the lessons for practical founders. They know they have a growing machine. Why should I sell it if I know it's going to grow? Well, you sell it because that's what they're buying. An investor, private equity or otherwise, is buying there. So Charlie Munger of, Berkshire Hathaway talks about this a lot. The power of compounding, longer term approach. I don't know that practical founders are particularly long term over short term, but they understand the leverage of compounding. Charlie Munger says the most important first rule of compounding is to don't interrupt the compounding. Don't take your stocks out of the market when you're feeling fearful. Keep investing, keep putting in your 401k, your retirement accounts, keep doing the same things. When it goes down, you keep going, you keep going, you keep going. The Berkshire Hathaway, Warren Buffett, one of the richest people in the world, he's got a very steady growth. I mean, it's not a slow compounding. He's beating the market overall. But in his world, he's in his 90s. 90% of his wealth was created after he was 60. So this is the patient game. It is the flywheel game, to keep the things going here. So part of the first rule of the compounding game is to find leverage and find ways to grow more efficiently, 30% a year, some reasonable number that is good for you, plus or minus, whatever it takes for you. And don't stop. Survival is a requirement, right? So it looks kind of boring and not very exciting or not cool to say, I'm going to build this company. We're going to grow 30%. We could grow a little bit more, but we're going to do the right thing. So next year we can grow 30%. And we could do a little bit more, but we're going to do the right thing. So the next year we can grow 30%. Most people don't think like that. It's actually a moat to build that company. People ask me, gosh, how can I do what you do? Well, go back 10 years and do all the things I did in the compounding game. The podcast is compounding. Then my knowledge is compounding. My reputation, brands compound, right? From little, do the right things for your customer and your market, and then you get a better brand and so forth. And, how do I get a great brand? Well, go back 10 years and do all the right things that make people trust you and believe you and get value and so forth. So practical founders think like this in the compounding game, and they know they're playing this game, and they know what their investors want. They like to stack small wins that turn into bigger ones. That's, it's a multiplier in the compounding game. We don't just do wins. We do wins that create leverage, right? That help us next year to, not everything we do is great for us, but what are the ones that 3 years from now we'd be so glad we did every day? That compounding game, I've used this in person many times. It surprises a lot of people. A lot of people don't know about this. The rule of 72 of compound interest or compound growth The rule of 72. Here's a simple math. How many years does it take if you're growing at 7% a year to double your business? The answer is 10. I just did the math in my head. That's 72 divided by 7. Okay, if I wanted to grow in 5 years, what is 72 divided by 5? That's about 14, something like that, 14 plus. Did that in my head, right? So 14% growth, you'll double in 10 years, or 30% growth. That's, gets a little wonky at the ends of the math spectrum there, but, it's 2+ years, 30% growth, it's, 60 and then some. So it's compounding on top of each other. Creating a valuable software company is not an overnight game. It's not a quick fix game. It's not the same thing you do at 1 million as 3 million and 10 million. Things are happening in the world, and the world is changing. But generally speaking, growing a valuable software company, growing a family, growing your finances, growing your health is about compounding. All right, let's talk about the next trait of practical founders out there that's really powerful and not so common.
This podcast is brought to you by my friends at Designly. If you're a non-technical founder with an up-and-running SaaS business, but your first product and dev partner aren't keeping up, it's time to check out Designly. Designly understands the pains you're experiencing right now. Dev leaders who speak in jargon and put you off, MVPs that went live and face technical problems and UX issues, and missed expectations all around. Designly's mission is to help non-technical software founders build great products with clarity, confidence, and peace of mind by serving as your fully outsourced engineering team. Designly becomes your trusted product partner, working with you every week as your dedicated team. They have partnered with over 200 non-technical and practical founders in the last 12 years. Designly knows how to turn that crazy product stress into calm and successful software launches. Check out their success stories from founders like you who've been there. It all starts with a free 1-week audit where they review your product's code, design, and roadmap to uncover what's working, what's broken, and what's next. Check out designly.co/practical. That's designli.co/practical to talk to them and see how they can help you move faster and sleep better.
You might be a practical founder if you turn down easy money, an acquisition or funding or something because, or the best offer for your company. You go for a better offer for your company so you can protect your ability to do it your way. The third trait of practical founders that is not so common in the world and even in the business world is the premium, the work that practical founders do to protect their independence. It's a little bit about control. I want to do it my way, and I want to have control of the way we do it. Maybe you give up control to a senior team that can also help get things done. The founder doesn't have to be the ultimate decision maker, but that founder stays there because they've created something in their own way, with their own style, with their own approach, and they really value that. It's not that they're control freaks. Leadership and the growth game is an exercise in relinquishing control to team members and systems and things like that as you grow. But it's still the founder magic versus the hired CEO magic. There's something special about every software company I've interviewed on the podcast, everyone I know, they created their software business with the normal mechanics and laws of nature of software businesses, creating value for customers, charging for that value, spending less than you make, keeping customers, and, those are, and having happy employees. Those are laws of nature you can't really defy, but there's a whole bunch of ways to do it. Practical founders put a very high premium on their ability to do it their way, right? So yes, they can see a lot of advice, they read books, go to conferences, talk to a lot of people, but they're still skeptical of the simple templates and the hype answers or even the popular ways to do it. I certainly am like this. I don't like somebody telling me what to do. I think there's a magic to the way I do things in my way that is special that compared to how somebody else would do it. And that's really what we're doing. We're creating businesses, we're creating ourselves, we're creating markets, creating products in the world. We're making this up. And it's pretty magical to do it in our own way. I think that's part of the founder magic that's, you know, a business run by a CEO, maybe that's public or bigger, private equity acquired, something like that, doesn't have that founder soul to it. And part of the founder soul is the credibility of having created it and know a lot about the business and the total context of the story that newbies don't have. But it's also about applying their special way of thinking, their personality, their style, their craziness, like my crazy here. You're hearing it today. It's not really I mean, it's not magic. It's not, crazy, but it's special and it's valuable and it's important to us. So we protect our right to do it our way. We keep our optionality, even if it doesn't. We'll pay a price for that, right? It's almost a visible price in some transactions. So there's control, ability to do it our way. And it's part of the magic of software companies. Gosh, in VC funding land, maybe there are some templates that everybody does it this way. But in practical founder land, once you have the fundamentals of a happy customers and happy employees and, a compounding machine, there's all kinds of ways to do it for tech founders, non-tech founders, older founders, young founders, founders in Denmark and Holland, and founders in Florida and Vancouver and, Sydney, in this market with this personality, with this timing, with this vision of what you want to create. There's all kinds of ways to do it. And let's say personality to it is really important. It's part of the magic. It's why we show up to play, because we can apply our superpowers and our styles to it. And it really helps. Not everything, we get to do our way. We have to figure out what those things are and get the leverage out of them. A lot of people have used the word freedom. Jason Fried, no pun intended, Basecamp was on the podcast. He's written books and he's talked for 15 years about staying off of VC funding, having profitable companies, doing it in your way. He shows the way he does it and the way he wants to do it. It's actually paid off enormously for him when everybody said, no, you should do it this way and take funding and so forth. He did it his way. And he's going 20 years into the business. He loves the business because it's a thing that lets him express himself and do cool things. It's what he wants to do. That's like at some point, it isn't just about, here's what you should do. It's about discovering what you're great at and what you really want to do. That's why I'm doing what I want to do. So, once your company's worth 10 or 20 million, how much money do you need or whatever? Why would somebody want to grow a business to 100 million and make it worth $1 billion or whatever that is? Is really because they want to. Maybe it's about the money. Maybe it's about the impact. Maybe it's about the puzzle. Maybe it's about the challenge. It doesn't matter. In the Practical Founders peer groups, everybody's got different reasons, different personalities. Yes, we're all practical founders and we're growing businesses, but what do you want to do with this thing? Everybody's got a different vision for it, and they get to change their minds. That's the optionality premium, is people say, I'll grow my business to this number, and then I'll sell it for 20 million or 50 million or whatever it is. And then something happens in their world. They change their mind, and an offer comes by and they take it. So they change their mind. Or they say, I do want to sell it, and they get better at it and they change their mind. They say, I want to go long. Why would I want to sell this? This is what I like to do. All kinds of ways to do it. It's the first contradiction of the institutional investor game. VC funding is one side of that for the rocket fuel for rockets, for startups. Private equity, acquisitions and first bite, second bite investments and eventual sales is part of that. You have fewer options when you sign up for this. And there's a trade-off. So eventually you might, and it doesn't matter, but practical founders fight for their independence for as long as possible. And it and treat it as a superpower, not just as a luxury. It's actually something that creates leverage in their business. Founders create leverage in their business when they do it right. And there's a little bit of a founder premium, the long-term super value of a company that keeps the founder in the game here. So yes, we make trade-offs as we grow the company. We create senior teams and organizations that, maybe reduce some optionality. We're committed to them as leaders and owners. Maybe you bring on a little funding that's practical, whether that's equity or non-dilutive debt or royalty-based funding. There's a little commitment there. So you can kind of bring those in, and that reduces the ultimate flexibility there. I mean, we're building compounding machines, so it's not like we want to stop tomorrow. That would be wise, but and eventually we may sell our company. So we make bets about our optionality and handle the timing. But again, we pay a premium for it. By the way, this is the reason why 90% of serious founders who've done it long enough, built something valuable, sell their company to a strategic acquirer, buys their company, and they go with them for a spell, or a private equity investor, which is how most founders are getting liquidity and multiple bites, right? These days, 70% of software acquisitions, especially for practical founders, come from private equity who enjoy the compounding and so forth. But you're giving up a little control, and you're, extracting a value and a price for that. So, but 90% of founders who get into the strategic and run their product suite inside a big company, I've done that before, have private equity board. Now they sell 51% of their company, and now they have a board, and, they still have ownership, but it's not the same thing. You're kind of dividing it up. Most founders don't have very much fun with that. Maybe that's the price you pay to when somebody gives you $50 million or something like that. But 80 to 90% of founders I've known, thousands in the 30 plus years I've been doing this and been through it myself a couple times. When your company's acquired or you take a big investment, it's tricky, it's difficult, and they'd rather not do that for very long. So they like their control. They like to be the person in charge, to grab, the one on the steering wheel, the ultimate decision maker. There's benefits of bringing in advisors and board members and senior teams and investors and all of that kind of thing too. That can make things better, but it's a different game, and it takes away some of that optionality and let's say the independence premium that we have there. So we have fun with this in our practical founders peer groups, because when somebody brings a challenge to the group and say, I'm struggling with this, and what do you guys think? We have a structured approach for that, but there's many ways to do it. There's no simple template. And so when we understand their business, themselves, their personality, their stage, their vision for what they want to create, their current version of what this thing should be in the long run, which they get to change their mind on, we get that diversity, that complexity is part of the game. That context is part of the game. When they hear, I did it this way and I did it this way, and you should talk to this guy, and here's a book about that, we get to compare that to our own context. And everybody's got a different version. So it's one reason I don't take equity in any of the companies I work with is it's your company. You've bought your freedom. I know there's a price on it. And if you want to sell it, that's fine. If you don't want to sell it, that's fine. If you want to change your mind, if you want to go faster, slower, it's up to you. You're making it up. It's your asset. It's your vision. It's part of you, at least for now. And that's really amazing. So we love that diversity. But there's no simple templates for all of this stuff. It's a wonderful puzzle, and it includes the founders and their own personalities and superpowers and magic tricks. So that is the fundamental premise of practical founders. We get to do it our way. When you do take an institutional investor, VC, private equity, and so forth, you don't get to do it your own way. And you're signing up for that, so you should be conscious of that. That's okay. That's another way to do it. But, you kind of lose the independence when you play that game. And maybe there's a time for that. So maybe that's the final phase as you put up with that transition time for a couple of years to, get your exit value. I've been through that. So I played that game, and I've learned things from it too. So there's all kinds of ways to play the game. Okay, so those are three things that if you are those three things, you make small bets before big bets. You have a frugal side, you have a, crazier but risk managed, investment side. That's one characteristic of practical founders. If you love the compounding game, if you're going to do the things now when your organization and your product, your architecture, we play these trade-offs, right? What is short-term? What is long-term? Not everything's long-term. We got to survive. But we play the compounding game to build valuable companies that will keep on compounding when somebody else takes over or 3 or 4 years from now. So that's the second one. And the third trait of practical founders, not so obvious, but when you hear, you can, let's say, re-listen to the Practical Founders podcast interviews that I've done so far, right? It's always there. And I kind of pull that out when I see that here. The last one is they did it in their way. That's kind of the fun of this puzzle. And it's kind of surprising. And it's kind of contradictory to let's say, the culture of social media and the quick fix and the accelerator, incubator templates for how you create a business. There's all kinds of ways to do it in different countries, in different styles, different ways when you can appreciate the laws of nature. So we actually have to be great at the laws of nature, the fundamentals of a business, our SaaS metrics, our product, our execution, all that kind of stuff to earn the freedom and the flexibility and the ability to make small bets before big bets. It's a really magical thing that I can see in every single practical founder. Again, I'm not selling you on these. I'm really saying if this is something, if all three of those you say, I'm that's, and if you have an up and running SaaS business, you're probably a good candidate to be in a practical founder peer groups if you like that approach. But that's what practical founders are up to. And gosh, those are some of my core values. I love these games. I don't think it's great. I think it's crazy to bet it all on something that just to act cool and because what is everybody else is doing. I think it's crazy to look for quick fixes that don't compound and create something very valuable in the long term. And I think it's crazy to, not curate your own point of view on things and understand yourself and your personality, what you're great at and how that can be applied and use that in your business. Like the earlier a software business is, the more the founder brain is part of the magic in creating a valuable company, getting that flywheel going. The bigger it is, compounding kind of takes over. Maybe you have some of that optionality and choice that kind of gets down, and you'll never get over, like, not every bet makes the same. Most employees don't understand that, right? Why can't we spend the next dollar on this? You're always looking for the best use of the next dollar to create something that compounds and create something valuable. So it's an amazing game. What an amazing time to be in the software game, creating these practical founder businesses with AI, making our businesses higher leverage and doing more with less every year, that the recurring revenue business is recognized as being so high value. Our ancestors have worked harder for less prize money and less results there, and our ability to change the world, to create something that expresses ourselves and solves a problem in the world, that creates an impact. It's really an amazing time to be a practical founder. So thanks all of you for listening today. And again, send me a note at greg@practicalfounders.com if you have a comment for me or a question. I'd be happy to answer. Thanks all.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.